Hello everyone and welcome back to Southern Wealth. I hope you guys are doing very well. If you do enjoy the content, please consider dropping that like and subscribe. As you guys know, it greatly helps the channel. So this week is a big week of news. Today we had the job revision day and we're gonna have PPI and CPI, PPI tomorrow, CPI Thursday. So it's gonna be quite the week. And then, of course, on the 17th, that's going to be next week, we're going to have the Fed meeting, in which now it seems a guarantee that the Fed's going to cut rates, either 25 basis points, and now the probabilities of 50 basis points are increasing. Yes, Powell is late. Wow, what a surprise. Yeah, Powell is late, the sky is blue, water is wet. There's nothing special about it. We've been talking about it for a long time here in the channel. But today I wanted to give you an example of what I meant all those months ago about basically there are three economies going on at the same time. And at the time, I remember a couple of you asked me questions, even on the live stream, because they really didn't understand what I meant. So, because people get this confused all the time. So basically you have the real economy, which is garbage. And how can you see it's garbage? Well, you see the results of the election. And when you look at the exit polls, basically people telling why did you vote the way you did, number one was economy, number two was inflation, which is pretty much linked to the economy. So that's the real economy. Garbage for around 80% of the population. So that's number one. Economy number two, the real economy, but reported by government data and propagated by media. The job report is a great example of that. And that's why I'm talking about this, because I sometimes talk about things which are theoretical, and then when you have a good, clear, real life example, you understand it immediately. The jobs during Biden, oh yes, because this revision has been blamed on Trump, but the data is until March 2025. So he basically was there for not even 2 months, or 2 months and 10 days. So you mean to tell me that that was the problem? The first 2 months and 10 days? No. The data was being overinflated to show a better economy fake than what it actually was. And this goes in line with what happened in the previous reporting. So in the previous reporting, 818,000 jobs were revised down. And this time they break the records at 911,000 jobs. So instead of an average close to 150,000 jobs per month, you're talking about an average of around 71,000 jobs per month, which 2 months ago was a terrible number. So this is the example, but you've been told that the economy is so strong, yet people voted the way they voted. And this is why the belief in the government and the belief in the media is at all-time lows. It's exactly because of this. Because the government and the media is trying to tell you that it's raining outside, and you look outside and you see the sun shining. And they're trying to convince you what your eyes are clearly telling you that's not happening. At least for 80+% of the population. And that is exactly what happened today. You saw a little bit the real economy. Now, what's the magic of this? Every month the job reports come out, and every month it influences the market. This revision happens one day, and by tomorrow nobody remembers. That's the key. The key is to repeat to you at the time that the job growth was great. Oh, it's actually really terrible, but maybe you didn't listen to this, so you'll forget. Great. Oh yeah, it's actually really terrible, but don't pay attention. Great. So that's the idea. is to repeat that is strong and resilient so often that you forget about the revisions. That's the point. So it's all fugazi. That's why I was saying that the Fed needs to cut urgently, because no, the job market is not good and it's not resilient. And you don't have to wait for these revisions. You can tell by the way people voted in the election. That's my point. The Fed, when they were cutting in September and October, they should have kept cutting all the way through. And they would have if the right candidate had won. That's my opinion. But the way they behave, it's very inducive of such a behavior, because it's impossible that they haven't seen the 818,000, and it's impossible that they look at the exit polls and they conclude that the economy is doing great. Yeah, right. And then the economy number 3 that affects the top 20% of the population usually, it's the financial assets economy, which does very, very well. And so you create the wealth inequality gap that you see portrayed everywhere. Now, are the top 20% stealing from the bottom 80%? No. The way people survive in the terrible economy situation is by the government spending a lot of money. That's where the deficits with Biden exploded. The deficits of Biden were hitting 7% of GDP. There's no recession. Yet they were hitting 7% of GDP to compensate for the fake data that was being put out in many parts of the economy. And because risk assets, crypto, gold, stocks, because they move with liquidity, they move with the number of dollars in circulation, these go up. So this is why everyone gets puzzled. How is the stock market at record highs if the economy is like garbage? Because the stocks don't move with the real economy. They are priced in dollars. And I could use this example for Canadian dollars, euros, pesos, yens, yuan. It doesn't matter. It's all the same. All these risk assets are priced in one thing, the currency. If the currency keeps getting devalued, either by central banks or by the treasury spending or by a combination of the both, it doesn't matter. The value of the numerator goes up because the denominator, the currency, goes down. That's it. So they're actually really not winning that much, but they're not losing at all. So it's a bit like, imagine a football team, right? The NFL has started again. Imagine a team that is pretty much identical to last year, but its competitors or its peers are losing players to injury all the time. So the team that is winning or is remaining healthy is actually not really moving that much further. It's the other ones that are losing. That's exactly what's happening. Most people have no investments. They have cash, they get a salary, they are one salary away from bankruptcy or from being poor. They invest no money, they take loans to go on holidays, they do all this kind of stupid crap. Or, unfortunately, they just cannot make enough money to live in the high cost of living, which I believe is the majority of people. So they cannot invest. So they cannot protect themselves against the currency being devalued like the top 20% can, because the top 20% invests their money in assets. And assets go up. And two assets outperform the currency devaluation: tech stocks and crypto. That's it. The other assets more or less keep up with it. So it's the principle of the team that remains stable without injuries versus the others that lose players to injury, versus one or two teams that actually draft very well, don't get injured, and get even better. That's the crypto and the tech stock teams. So I hope that becomes clear. And actually, here's the funny part. The reason why the Fed needs to cut rates is because the economy and not just the US economy, pretty much the Western world, including China, they cannot handle high interest rates. Because interest rates, now I'm not talking about the financial assets, because people think, oh, if the economy cannot handle high interest rates, then we cannot have stocks going up, right? If interest rates needs to be low, so stocks can go up. Wrong. You just seen record stock market, record crypto market, record gold market with high interest rates. Why? Because the deficit spending compensates for the high interest rates. But that's for the financial assets economy. That's for the economy number 3. That has nothing to do with the real economy, the economy number 1. Because you have to understand that the smaller businesses, this is why the Russell 2000 struggles, the smaller businesses cannot go to the bond market and issue bonds all the time as easy as Apple, Microsoft, and the likes. Many times they have to have bank loans. Bank loans have a problem. They get financed. So how does a bank loan money? They go to the central bank and they pay the overnight funding rate. That is called also the Fed funds rate. And then they pass that cost to the consumer, the business, and they charge a margin on top, and their money is basically the margin they make. So let's say the Fed funds rate is 4.5%. A bank goes into the Fed, gets the money at 4.5%, and then loans the money to a business at 7%, which is 4.5 plus 2.5% margin. You get the 7%. But if the business gets funded at 4.5%, and they used to get funded at 1%, for example, who do you think pays the extra 3.5%? People, if they can pass on that cost. The funding cost of a company with a bank is a financing cost, is a cost like no other. And the bank cannot lend you money at a lower rate than what the bank pays to the Fed to get funded. So if the Fed funds rate goes higher, that cost gets passed to the consumer, and in a very indebted economy, that actually creates more inflation. When you cut rates, you reduce a big cost of financing to the smaller corporates, so inflation actually goes down, as opposed to what all the economists say. Because, as usual, all the economists are wrong. Surprise, surprise. Do you want an example of this? China. China faces deflation, does nothing but lower rates. And they get more deflation, and they don't understand why. Another example, which country in Europe has the lowest inflation? Switzerland. What are their rates? Oh, 0%. But I thought low interest rates meant high inflation. That's what they told me. Right? How is this possible? I told you. If the cost of financing for a bank with the central bank, which is the Fed funds rate that everybody talks about, is higher, the bank needs to charge that plus a margin on top to the company. What does the company do? They pass that cost as much as they can to the consumer. But now you say, oh, but if interest rates are too low, then I don't save money because, I'm not going to save money for a deposit paying me 0.5%. Forget, I'm just going to spend the money, and that's going to create inflation. The problem is 80% of the population doesn't save money. So they're already spending the money. Number 2, if you are part of the 75-80% of population that is already over-indebted, remember what I said? It's already over-indebted. When you try and go pay and go get a loan, oh, interest rates are 1%. Hey, bank, give me 100K, please. Interest rates are so low. The bank looks at you and says, hey, your credit score is garbage. You have a mortgage. You have 2 car loans. You have a personal loan. You have student loans. I'm not going to lend you a credit card debt. I'm not going to lend you a penny because I have no idea if you're going to pay me back. Go away. Contrast that to Jeff Bezos. Hey guys, give me 100 million at 1.5%. Sure, Mr. Bezos, take it. What do you think he does with that money? He buys assets and expensive gifts, sure. But you have to understand, if Jeff Bezos spends $1,000 on dinner, he's buying one dinner. If you have 100 people spending $100 on dinner, that's $10,000. That's 10 Jeff Bezos consumption and impact on the economy. So that's why you see asset prices going up, because the top 20% benefits from the low interest rates and they can buy assets. And also it's linked with the liquidity that is being created by either the central banks or the treasury spending money. The bottom 80% don't go anywhere. So whenever you hear this conversation, oh, if interest rates go down, the inflation is going to spike. No. Inflation is actually going to improve over time as the interest rates come down. And everybody will throw their hands into their head and don't figure out what's happening until they forget that they were advocating for high interest rates to fight inflation. They'll just talk about something else and they will forget what they said. And with this is the basis of why I'm so bullish towards asset prices. Because I believe with the level of leverage, both private and public government debt that exists in the system, we cannot live with low liquidity environments. Because if you strip the liquidity out, asset prices fall. Assets are collateral to debt. So debts start to fall. Who owns the debt? Banks. So banks start to fall. Who does the central bank represent? The banks. So in my view, they will just devalue the currency again. And the great hope is that productivity goes so strongly that eventually we'll get out of this debt prison and we can move to something better. And with that, that's the basis of my thesis. That's why I buy crypto, because I've seen the crypto, just like all the other assets, real estate, doesn't matter, they move in the same direction because they are being moved by the same dynamics. Crypto just outperforms everything else because it's a smaller market. It's easier to push higher. And number two, for the real cryptos, the inflation is either capped, in the case of Bitcoin, at 21 million, or much slower than the creation of currency, like Ethereum, and they end up outperforming everything else because of that. What's the problem of stocks? Management is incentivized to issue shares. What is the problem of commodities? If commodities go up a lot, they dig more of them. That's it. But look, bear in mind something, this is just my opinion. Maybe my analysis is completely off. Maybe all these factual occurrences are just magical coincidences. Who knows? But thank you very much for being here. Don't forget, like and subscribe. I'll catch you in the next one. We'll try to post on Thursday. Don't forget, a like is free, still free. A subscribe is still free. I don't ask anything else. And I'll catch you in the next one.